Since tax reform was enacted in December of 2017, our economy has grown and strengthened, with American families and businesses seeing real benefits. And you just heard Senator Grassley say some of the same things about how the economy is booming. Unemployment rates have dropped dramatically, with unemployment among Hispanic, Latino, and African American workers at record lows. According to the Bureau of Labor Statistics, average hourly earnings have grown at a rate of 3% or higher for 16 consecutive months, with the largest wage gains concentrated in the bottom quarter of the wage scale. We should duly note that production workers' wages are growing much faster than wages for manager class. In short, lower income workers are seeing the highest wage growth. But instead of looking at the positive economic effects of tax reform, our Democratic colleagues insist that large corporations have received a massive giveaway and only the wealthy have benefited. That is simply not true. Tax reform addressed a number of issues that were frequently highlighted by both political parties. In particular, tax reform made enormous progress towards creating a more competitive environment for American companies. Now, before tax reform, the combined U.S. federal and state corporate tax rates was the highest in the developed world, 15 percentage points higher than the average of the other 35 advanced economies that are members of the Organization of Economic Cooperation and Development, which we commonly refer to around here as OECD. Now, you heard about the last few years before the tax bill of companies going overseas. We had inversions, foreign acquisitions of U.S. companies, and the erosion of the U.S. tax base. These were all very significant problems that we addressed in the Tax Cut Act of 2017. And with our worldwide tax system, companies were actually incentivized to store corporate profits in low-tax jurisdictions overseas instead of reinvesting them back here in the United States. How can that help the United States economy? We had perverse incentives to keep wealth out of this country. Ironically, even Democrats highlighted these same issues in the lead-up to tax reform. A bipartisan recognition that we shouldn't have a tax system that encourages the storing of money overseas instead of bringing that money and capital back to the United States to create jobs here. They are only partisan issues now, as it turns out, because tax reform was a Republican effort. But both sides of the aisle knew that these issues had to be addressed for U.S. companies to remain competitive and for the U.S. economy to continue leading the world. Critics of tax reform complain that the 21% rate is too low. But with the average corporate tax rate of 21.7% among the OECD countries today, the United States is finally in line with our peers. In other words, we can be competitive. As a result, U.S. companies are competitive, and investments in the United States are more attractive not only to foreign companies, but to U.S. companies that used to store money overseas. After a tax reform legislation passed in 2017, business investment rose by 6.4% in 2018. While a weaker global economy, tariffs, and other factors subdued growth last year in 2019, business investment in 2018 and 2019 combined was still $5.7 trillion, and that hit record highs. Capital expenditures of S&P 500 companies have risen by 17% since tax reform, and research and development expenditures of S&P 500 companies rose by 18%. All of this showing that our law accomplished what we wanted it to accomplish. Hardly, then, the anemic response to tax reform that the Democrat critics would have us believe. Tax reform has changed our international tax rules to remove barriers that previously prevented companies from bringing foreign earnings home. In the 7 quarters since enactment of the tax reform, U.S. companies have brought back to the United States more than $1 trillion of foreign earnings. And obviously, U.S. companies are using these earnings to finance new capital expenditures, increase research and development, increase payrolls, pay down debt, and return cash to shareholders and retirement accounts. The companies are putting those earnings to work in this country, not leaving them abroad. That economic gain and the jobs created as a result of it is because of the 2017 tax cut legislation. But we also took care to ensure that companies wouldn't be able to take advantage of the new U.S. tax system. Tax reform made significant strides to address inversions, capital takeovers of U.S. companies, and base erosion. And you remember the outrage we had before the tax bill when there were inversions and foreign takeovers of U.S. companies, and then the result of erosion of our tax base. Together, lower tax rate and new international rules have changed the way that companies structure their business operations. For example, Assurant, a global insurance company, changed its acquisition agreement so that its new parent company remains here in the United States. Broadcom, a technology firm, announced that it would return its headquarters to the United States, and this came after tax reform. Similarly, several energy and pharmaceutical companies that had previously moved out of the United States also made the decision to return primarily because of tax reform. You know, the old saying can apply to this tax legislation. What we wanted to accomplish was accomplished, and that old saying is, the proof is in the pudding. So tax reform has leveled the playing field and made the United States a far more attractive place to do business. Hardly the dire consequences that critics would have us believe. Now, you know, critics never give up. Not to be deterred, the critics continue to look for misleading information to distort the picture. Most recently, they've pointed to the Congressional Budget Office projections as evidence that tax reform and recently issued U.S. Treasury Department regulations have provided a windfall to corporations. I hate to see Congressional Budget Office's professional work and nonpartisan work manipulated to say something it clearly does not. And I meant to use the word manipulated. First and foremost, CBO's, that's the Congressional Budget Office, downward adjustment of expected corporate tax receipts does not imply that CBO scores particular Treasury regulations or that a regulation departs from congressional intent. Rather, CBO's adjustments broadly reflect significant economic factors and changes in government data. In particular, CBO adjusted its projections because we now know that Bureau of Economic Analyses estimates of corporate receipts between 2016 and 2018 were actually overstated. So you got to make adjustments for that. In short, even pre-tax reform projections of corporate profits were really too high. So when the estimate of corporate profits is corrected, it translates into lower tax receipts. But the other side doesn't seem to acknowledge this. CBO also took into account current economic factors like recent trade actions and tariffs, strengthening of the U.S. dollar, and the softening of foreign economies, all of which affected expected corporate profits and ultimate tax receipts. But our critics don't seem to acknowledge that fact. In addition, Congressional Budget Office revised its projections to reflect everything that we're learning about implementation of the new tax rules, including regulatory guidance, new forms and instructions that go with the tax forms, and modeling improvements to better reflect updated economic projections. And CBO is only beginning to take into account how U.S. businesses are responding very positively to the new tax rules and Treasury guidance. As many regulations are still being finalized, businesses are only starting to have needed certainty to invest in new property and equipment, to engage in mergers and acquisitions, and to enter into new business transactions. The Congressional Budget Office's projections are also based upon preliminary data. Tax returns for the first year of the new law were filed less than 6 months ago, but the critics don't take that into consideration. The final data will not be available from the IRS until later this year, and even then will still take time to fully analyze, but our critics don't recognize that. All of these factors go into CBO's revised projections of corporate tax receipts, and none of them support the claim that Treasury provided a windfall to corporations. I think the critics ought to go the extra mile to study and understand the impact of the tax cut law. There simply is no basis then for the critics' claim that the revision to CBO's estimate of corporate receipts means that Treasury has given away the store to big corporations through its regulations. Despite the critics' relentless attack, the benefits of tax reform are, in fact, proving out. All you got to do is look at the good economy to know that that's the case. I'm encouraged by the promising economic data that I just referred to that suggests that American workers American families and American businesses are seeing positive effects. Now, we must continue to promote policies that encourage U.S. businesses to keep operations on American soil. The 2017 bill does that. Increase wages. The 2017 bill did that. And reinvest foreign earnings in the United States instead of leaving them overseas. And the 2017 tax bill does that. I hope that my Democratic colleagues will stop criticizing the policies that have strengthened our economy and, in fact, consider how we can work together to make our tax laws work even better for American businesses and workers.